How's it going, guys? Welcome back to the channel. My name is Sam, and today we're going to be discussing the most common trading mistakes that I see people making all the time. As always, guys, please remember to subscribe down below, turn on the post notifications bell, and hit the like button. It helps my channel out a ton. And make sure you watch this video to the very end, as I'm going to be dropping a huge tip that I think will benefit a lot of traders. What is going on? Why? 95% of traders lose money in the stock market. Most of them don't even last past 6 months. Of all the traders that exist, a very small percentage of people are actually profitable. And from my assessment, education and experience are the two primary drivers that are responsible for the lack of success in most traders. You see, trading is as much an art as it is a science, and most traders don't even know how to conduct fundamental and technical analysis. So despite a whole host of reasons why someone might not be successful trading, I've noticed a pattern of mistakes that most people seem to exhibit. Now, don't get me wrong, when I first started trading, I also made these mistakes. So here are some of the mistakes that I see a lot of people making. Number 1. Trading with emotion. Trading is a calculated game of risk reward. After conducting your thorough due diligence on a stock and having a trading plan, you need to be methodical. Remove all emotions when it comes to trading and instead rely solely on logic and reasoning. It's not uncommon for the novice trader and even the professional traders to get cocky after a profitable trade and then start to think that they have the Midas touch and start involving themselves in trades that they have no business being in. This is known as the hot hand fallacy. From what I've seen and what I've assessed, it seems to be that fear is the primary driver behind a lot of people's losses. The fear of losing gains or losing your capital results in the loss of an incredible buying opportunity. Or the fear of missing out, otherwise known as the infamous FOMO. FOMO into a stock so you don't miss the rocket up to the moon and you end up holding a fat bag. Now you're no longer trading the stock, but instead you're a long-term investor in this dog company. You end up holding so many shares you might as well run the board meetings. Here's a scenario. You're sitting there watching a stock rally and rally and rally and rally. And you're thinking, great, she's flying without me. And after a little bit, you start to think to yourself, all right, it's done. I missed it. What are you gonna do? But you can't look away. You just keep looking. And you see this thing make new highs and new highs. And with every green candle, you die a little inside.
This is the worst!
You see so many green candles, the room starts spinning and you don't even know where you are anymore. At this point, you're dripping in sweat and you just decide, whatever, I'm YOLOing in. And it's at that moment that this stock crashes back to reality, you lose a whole bunch of money and you realize why you suck at trading.
And it's gone.
It's a tale as old as time, or as old as the stock market. We've all been there. We've all FOMO'd in. We've all lost a lot of money. It happens. You need to learn from that. I've seen many stocks rally without me, and I've seen many more stocks plummet without me. Remember, there's always another trade. There's always another opportunity. Big homie Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. Now, I know this might contradict the whole notion of not trading with emotion, but Warren Buffett isn't actually alluding to trading with emotion. What he's actually suggesting is that when people are getting greedy, they're not thinking logically and are overinflating a certain company or stock or market or whatever it may be. So that is the moment for you to pull out. When others are fearful, you can actually find great companies undervalued and on sale. Number 2, blindly taking trades without doing your own research. Always conduct your own due diligence. Never blindly follow a trade and invest your hard-earned money into a company you know nothing about and without a proper trading plan. Know the fundamentals of the company. Conduct some technical analysis. Look at the history of the company, its chart, and understand how it behaves in response to the market. Develop a hypothesis and look for a catalyst that will propel this stock in the direction that favors your position. If you're long, look for a catalyst that will make the stock go up. If you're short, look for a catalyst that will make the stock plummet. Know what you are buying into. It's your money and it's your future. Number 3, know what kind of trader you are. Your trading strategy should reflect your personality. Do you find it hard to stomach volatility and you can't sit there and just watch a ticker all day? Then maybe scalping isn't for you. Maybe you're better off swing trading with catalysts that are weeks and months out. Do you find it difficult to actually hold a position overnight and find it difficult for you to sleep knowing that you have all this money tied up in some kind of play? Would you rather close out all your positions at the end of the day and only have your money invested into a really strong ETF? Then maybe scalping and day trading is for you instead of swing trading. Know what kind of trader you are so you aren't finding yourself in uncomfortable trades or with a poor trading plan. Number 4, forcing a trade. People will look to the markets for opportunities to swing or scalp something just for the sake of having action and trying to turn a profit. This mentality can cost you a lot of money. Never force a trade or look for something if it's not there. Have a watch list, pay attention to the markets, and if an opportunity presents itself, that's the moment for you to jump in and ride that wave. Don't force a trade or look for something to swing or scalp just because you want to have action and just because you want to make money. In addition, here's a tip for traders. Stocks move in sectors. You need to pay attention to what the overall sentiment of the market is. Is it pessimistic? Is it optimistic, bearish, bullish? And where the volume is. The volume finds the theme. If Bitcoin is rallying and you see a lot of people pouring into Bitcoin, watch for the Bitcoin stocks to see if that sector gets hot. Mara, Riot, BTBT, Square, PayPal. If news about MJ comes out, then watch for the MJ sector to get hot. EXO, ACB, Tilray, SNDL. If there's a lot of civil unrest and there's a lot of protests going on, watch for Riot stocks. DGLY, VISL, AXON, SWBI, RGR. Is electric vehicles getting hot? Watch the EV sector. Tesla, FSR, CCIV, BLNK. Pay attention to sectors and themes that are getting hot to help direct you to your next winning trade. Guys, leave a comment down below with other mistakes traders often make, and if you have any questions for me. Thanks for watching, guys. Till the next one.